Hello everyone, I'm Ted Cohan, one of the senior portfolio managers here at Baker Barr Bank, and this is just kind of our quick monthly update to give you an idea of what we're seeing in the markets and economy and any changes we're making to the portfolio. So what we're going to talk about today is we're going to call kind of the good and the bad session. We're going to talk about some of the good that we've seen so far this year, which is going to be talking about some of the economic numbers. And then on the bad side, talk about inflation and some of the Fed forecasts that we're seeing now based on the economy and inflation numbers. So I'll start on the good side and talk about what we've seen so far this year in the economy, which we've seen really good, strong job growth, which has also led to continued low unemployment rates, really historic low unemployment rates, which is great. We've also seen very strong consumer spending and also really strong retail sales. So far this year, what we've seen is a much stronger economy than we were expecting, which is good news, economic-wise. What that also does is coming into this year, one of our forecasts was a possibility of a recession at some point in 2023, and even first and second quarter was a possibility. We really believe with the strong economy that we've seen is that we're not going to have a recession in the first half of the year. It's still certainly a possibility in the second half based on what we see, moving forward. So that's the good side. And then if I move to the bad side, what we're looking at is inflation numbers have continued to come down from what we had the peak of last summer. About 9.1% was the peak of inflation last year. Inflation numbers do continue to come down. But the bad portion is they're not coming down as fast as expectations were, or certainly not as fast as the Fed would like to see. So what that really leads us to believe is a combination of, with inflation not coming down as fast as we were hoping, and also with the economy being stronger than expected, that the Fed will probably raise rates farther and higher than we thought they were going to be, and potentially keep them higher longer. So at the beginning of the year, expectations were that the Fed would raise rates in February, which they already have done, and March. Now, based on what we've seen, is there's expectations that the Fed will probably raise rates into May and possibly June, and then also keep rates at a higher level longer. What that'll do is continue to have increased borrowing costs and make it harder for the growth that we've seen to continue at this pace. So what we're also looking at is probably not a Fed rate cut until the end of next year. And so that's kind of the summary of the good and bad of what we've seen. Portfolio-wise, Tyson at the last meeting, or the last video we did last month, talked about some of the changes we've made, which was lowering that stock exposure, increasing the bond exposure, also increasing the bond credit quality. We still think that will work well in the environment that we're seeing. And then the other change that we've made really over the last year plus now is to add a commodities fund and increase our hard asset exposure, which should continue to benefit us again in the environment moving forward. So that pretty much kind of sums up the monthly video. So thank you for taking the time to watch this, and we'll be back with another update next month. So thank you.